Welcome, and we're going to discuss payroll accounting, specifically income tax withholding as its relationship to payroll accounting today. First and foremost is what is the coverage under the federal income tax withholding laws? State laws are going to vary from state to state, and there may even be some municipalities or localities that also have income tax provisions written into them. That is something that you're going to have to become familiar with as you deal with your own type of situation, your own employers, and knowing what is at play for them. However, it's important to note that every person is deemed an employer if the person employs one or more individuals for the performance of services in the United States. Now, this should not be completely unfamiliar to you because of the fact that this is the same definition underneath FICA. So the same definition for FICA applies to federal income tax, at least at the base of the definition. Person's a general term, and it encompasses a variety of entities from individuals, trusts, estates, partnerships, and corporations. The word employment applies to any service performed by employees for their employers, regardless of the citizenship or residence of either. And the definition of an employer was pretty fairly well covered in the Social Security tax lesson. So you can always go back and look at that. But as a general reminder, we use what's called the common law test. And the common law test is based on a history and is currently represented in 20 factors. There are copies of documents that will help you ascertain this in your resources. But here we have the actual IRS website where the common law test issue can be further reviewed. Now, basically what it comes down to is that if a person tells or has the right to tell a worker how, when, and where to work, the worker is considered an employee. That's just a rule of thumb. When we do have employees, once we've ascertained that someone is an employee is an employee. It does not matter what their seniority or their status in the organization is. All employees are treated fairly and equally. Some individuals that are not employees by test, but they're covered underneath federal income tax federal income tax withholding laws are agent drivers, full-time life insurance salespersons, the home worker, remember that's the domestic worker, and traveling city salespersons. People that are not considered employees are directors of the boards who only perform meeting services. They're just showing up at the meetings. Partners are not considered employees. Direct sellers, so if you think of like Scentsy, Mary Kay, Pampered Chef, all of those are not considered employees. And qualified real estate agents. So now that we know what an employee is, the next thing that comes into play, as you'll recall, is that how much of this is actually taxable. How much of what is received by the employee falls within taxability. So that's called taxable wages. By and far, most anything is going to be considered taxable unless it is specifically excluded. The definition of wages is total compensation paid to employees for services. Taxes are withheld from these wages on their gross amounts. This means the full amount. And compensation can include avenues of paying the employees that are not in the regular wage consideration. These come in many forms, from gift cards, moving expense reimbursements, education benefits. And of course, there are some exemptions. And if the wages in any specific period are grossly considered non-taxable, so 50%, then none of the wages are subject to withholding for that period. And the inverse of this is true as well. Let's take a minute to look at this chart and the list. As we can see, things that make sense to all of us: wages and salaries, vacation allowances, supplemental payments, bonuses, and commissions. We'll talk about fringe benefits here shortly. Tips, you'll recall that tips are considered taxable wages from when we spoke about FUTA. Cash awards. But you'll notice as we move over that meals and lodging provided for the employees' convenience are treated as taxable wages. Payments to non-resident aliens are subject to withholding. Scholarships, sick pay, supplemental unemployment compensation, non-accountable plans for travel and business expenses. We actually go into that a little bit more deeper here shortly as well. So let's talk about those fringe benefits. Fringe benefits are part of the package that are provided to employees, and they can be all kinds of manner of things. They are just part of what the employee receives in addition to their compensation. So elements that are taxable are the personal use of company cars, free or discounted flights such as frequent flyer mile flights, discounts on property or services, vacations, members in social or country clubs, tickets for entertainment and sporting events, and anything that is not specifically defined as non-taxable. Now, non-taxable is services that are provided at no additional cost, what we call qualified employee discounts, working condition fringes, qualified transportation fringes, use of on-premise athletic facilities, reduced tuition for education for the employer benefit, job placement assistance, and really what is really best is to go to Publication 15 Circular E, the Employer's Tax Guide, for additional information. This is a great resource. You can get it on the IRS website free of charge, easy to access. Now, as I said, unless they are defined as non-taxable, the rule of thumb is going to be that all fringe benefits are considered taxable for federal income tax withholding. The taxable portion is the amount by which the fair market value exceeds what the employee paid plus any amount the law perhaps excludes. These determinations have to be completed by January 31st of the following year. And that date is going to come back to you a lot. This is the date of which your W-2s have to be mailed as an organization. During the course of the year, the employer can utilize reasonable estimates for paycheck to paycheck regarding withholdings and tax at the same rate as the rest of the wages, which we'll be talking about here shortly, or withhold at the flat percent of 25% for supplemental wage rate. Again, we'll talk about that as well here in a bit. Employers can choose to not withhold federal my words today are apparently eluding me. Federal income tax withholding on the personal use of a vehicle, but they absolutely have to withhold FICA or railroad retirement taxes on these amounts. There's a special rule that allows employers to choose a cutoff date other than December 31st to determine what taxable fringe benefits are reported in which year. If the benefits fall after the cutoff date, they will be reported in the following year. This special rule must, of course, be applied uniformly and equally among all employees the benefit is applicable to. There are some fringe benefits that are almost nearly impossible to track to determine for taxability. And the IRS and the federal government recognizes this. They are called de minimis. These are property or services of which the value is utilized personally would be considered be considered taxable is so small that it is not considered material, and the process of accounting for it would be unreasonable or impractical. Some examples of this are personal use of a company cell phone, especially now that we have these plans that are unlimited, or they're so large in minutes that it's pennies per call. Coffee that's kept on site and used by the employees, snacks, things of this nature. We don't look to track to the employees for taxability. Now, you'll recall that in our Social Security lesson, we discussed how tips are taxable compensation, and that employees must report their tips to their employers by the 10th of the following month, minimally, but the employers can request a more frequent reporting. Tips include those that are added to the credit card charges and the cash received by the employee directly from the customer in the form of cash tips. If for some reason tips are less than $20 a month, or tips are of a non-cash nature, there is not a need to report them. Employers collect taxes on tips as well as the wages that are paid. Remember, there's that tipped minimum wage that our tipped employees receive each pay period. If the taxes to be withheld that are calculated exceed the amount of wages that the employee will receive for that given period, so in essence, it would create in your mind a negative paycheck. The employee has to pay the uncollected portion when filing their annual tax return. So you don't collect it from their next paycheck. You just call it good. They don't receive pay check because you withheld everything, and it gets taken care of with their tax return. Now, for some of us, this might be a boon. For other of us, it might be a big giant pain, but some people travel for work. Employees that are required to travel for work can have those expenses covered in any number of several ways. Employers may arrange for and purchase tickets and pay for lodging directly, or they may have the employees do that and reimburse them. These are period expenses to the employer, and they're not taxable to the employee if it's coming directly from the employer, arranges and pays for it. However, traveling can entail more than getting to the location and sleeping. And this also comes in when the employee has to front those expenses as well, or they have to make the arrangements. Travel expenses can include needed laundry care and meals, as well as entertaining of clients. If the employer requires receipt documentation and an accounting for the amounts that will be reimbursed to the employee that was paid from the employee's personal funds, this is an accountable plan and non-taxable to the employee. If the employee is given a cash allowance, so say they're provided with $500 towards their travel expenses, then this creates the need to determine taxability based off the expectations of the employer. The travel has to be business connected, and if the employer requires that the employee provide adequate accounting and documentation for funds spent, so here we're talking about receipts, and a return of any of excess, this is an accountable plan and non-taxable to the employee. However, if the employer provides the $500 with no requirements to account for it or return the excess, this is a non-accountable plan, and thus the $500 is taxable to the employee. So to give you an example of what we often see in play as a non-accountable plan. Some people get what's called per diem pay, and you may have heard about this before. What it does is it stands for the employer will pay the employee a stated amount per day for their travel needs. Per diem, it is what is called typically a non-accountable plan. because the employer often does not require that the employee detail where every penny was spent and return the excess that is not spent in that time frame. So if a person with per diem pay can cover their expenses for less than their per diem pay, they have the added bonus of keeping the excess. This type of plan is non-accountable and is deemed as taxable to the employee for federal purposes. So here we have, of course, the thing that happens with pretty much anything that deals with the government is that there's going to be exemptions, and these are the typical exemptions to the withholding requirements. These payments are defined as exempt payments under the law as of 2017. The law excludes certain payments, including ministers' wages, salaries, advances, educational assistance, if we maintain, or educational assistance if it maintains, improves job status, and basically relates to what they're doing. And there's a limit to this. Qualified moving expense reimbursements, transportation in a commuter highway vehicle transit pass. This has a value of $255 a month. So we see this a lot in urban areas, where if they're using, the light rail, RTD, better known as RAFTA over here, their passes are paid for by the company. Now, in addition to these, there are certain amounts that an employee can authorize an employer to withhold from their pay on what we call a pre-tax basis. This means that the amounts that are withheld and paid on behalf of the employee for specifically defined items are removed from the gross pay before taxes are calculated. These apply to taxation in regards to federal income tax. Now, kind of clicking right along, we just talked about those possible pre-tax salary options, right? Now we're going to dig into that a little bit more significantly. Under Section 125 of the Internal Revenue Code of the United States, employers can offer employees the choice between cash pay or qualified non-taxable benefits. These types of plans have to meet specific defined requirements and regulations as detailed by the IRS. The employer will create a basket of qualified non-taxable benefits. The employee can then choose amongst those up to a certain amount. The salary reductions that are withheld to pay for the contributions to these benefits are taken pre-tax, and then thus are not included in taxable wages for calculation of federal income tax, FICA, or FUTA, and most state taxes. We're going to look at a few of these a little bit more closer here shortly. But here, as you can see, the example of some of them are like accident and health insurance, self-insured medical reimbursement plans, group life insurance coverage. And notice that's only up to $50,000 worth of coverage. $5,000 worth of dependent care assistance, health savings accounts. There's kind of a theme here that you'll notice, and these are all different types of payments that you can make that would be potentially deductible on a tax return, especially if you itemize. However, a lot of people don't have to itemize. They can take the standard deduction, but by utilizing pre-tax salary reductions, they can cover some of these things as well without having to pay taxes on those amounts. So let's talk about flexible spending accounts. These allow employees to have withheld from their wages funds used to pay for out-of-pocket medical expenses. In the end, unused monies are forfeited. And in 2017, the limits were $2,550. One of the things that unfortunately seems to be becoming more and more of an issue is high deductible health insurance coverage. These plans are popping up as part of employer plans These are also plans that are regularly becoming the affordable plan as a result of some of the things that have happened over the last few years legislatively. For employees who have these types of high deductible health insurance coverage plans, they can use health savings accounts to pay for the medical expenses. Contributions can be made by the employer and or the employee. It's non-taxable to the employee if it's an employer contribution. Employee contributions are subject to taxes if it is not part of a cafeteria plan. And the limits on these particular types of plan vary based on the age of the individual and the coverage. One of the ones that everybody at least has an awareness about, even if they have not actually participated in one, is deferred retirement accounts. So pre-tax salary reductions exempt from federal income tax withholding also are tax deferred retirement accounts. Now you will recall they are not for FICA, but they are for federal income tax. Employees can contribute funds to these particular accounts to be held until they're ready in a tax-free environment. Tax-deferred retirement plans allow employees that opportunity to set aside funds from their current wages. These will be distributed in the future during their retirement. Many of the benefit plans include some level of employer contribution to the plan. So that is also an additional benefit. Amounts contributed by the employers are not taxable to the employee. These are expenses to the employer. Original contributions by the employee and the growth of any of these funds over time in the form of dividends and or appreciation occur tax-free until the time they're distributed. These monies are taxed during the time of distribution, and it is assumed that that particular point in your life you will likely be in a lesser tax rate than that of an employee during the height of the career wages. Therefore, you will save in the taxes. Here we have a list of the different common types you'll find. There's the 401k. This is the standard tax-deferred retirement plan. The employee determines a set percentage of their wages, which are contributed on a pre-tax basis. Employers can limit this contribution lower than that set by law. And employees can do additional after-tax contributions. Employers can also contribute to the 401k and often do in the form of some type of matching up to a maximum percentage. In Section 403B, this is very similar to the 401k with the exception that it is made specifically for employees of tax-exempt organizations. Section 457B is a plan for employees of state and local governments and of tax-exempt organizations other than churches. And then we have the simple. This is for small companies. They have to have no more than 100 employees, and it can also be part of a 401k. Here in this next slide, we're going to look at what some of the parameters are on these. So each of these different types of tax-deferred retirement accounts have specific definitions and limitations attached to them. Regardless of the type of the account, there are some makeup amount provisions that can be contributed if the individual is age 50 or older. So as you get closer to retirement, they allow you to contribute more to go towards your retirement. Employers must withhold and match FICA tax on these amounts, but it is tax deferred for federal income tax withholding purposes. So as you can see here, the limits vary quite exceptionally. So $18,000 or 100% of pay. The lesser is the maximum employee deferred contribution. $6,000. This is the extra amount that can be deferred if you're the age 50 or older. That is then also changes to be $100,000 of pay or $54,000, whichever is less. $54,000 is the maximum total combined contribution. As far as a regular individual is concerned, if they go and they are age 50 or older, they have that $6,000 makeup, so then it becomes $60,000. Underneath is simple. There's a lot less that can be saved. So an employee can save $12,500 maximum, with an additional $3,000 as makeup if they're age 50 or older. But an employer has to match the employee's contributions in a simple up to 3% of the pay. However, in a 401k, 403b, 457b, there is no requirement of employer match. Now we're going to talk about something that doesn't 100% always stick to payroll, but it does apply to retirement. So we have the payroll-related tax deferred accounts that we just spoke about. But in addition to those, employees can set up their own individual retirement accounts. These are super easy to open using your financial institution or investment agent. The limits and deductibility are going to vary depending upon income and the participation of the individual in a qualified employer plan. Traditional IRAs are generally considered tax-deductible contributions. However, that tax deductibility occurs at the point of your tax return. Roth IRAs are non-tax deductible contributions. So these come after everything has been taxed. With a Roth IRA, when you go through distributions, what happens is that only the earnings are going to be taxed at distribution, but the return of original contributions will not, because it has already been taxed. I know it's a little bit of a complicated thought process. We just want to let you be aware of what there is available on a general level. You shouldn't have to deal much with things such as Roth IRAs from a payroll level unless you are direct depositing a certain amount into somebody's Roth IRA account. Once it's there, the taxability in regards to what or won't be taxed when they receive it falls on the institution. Now we're going to start getting into kind of the meats and bones of the matter, right? Let's start talking about federal income tax withholding. So we'll start talking about this in the Form W-4. And once we get through the generalities of this and start calculating federal income tax, we'll actually take that into a separate video because we will have a lot of examples that relate to this. So for federal income tax withholding, employees are going to exempt a portion of their wages, and this is based on an improved formula for personal allowances, special allowances, itemized deductions, tax credits, with ideally the end that the amount of federal income tax withholding that is held from the employee is going to be equal to their tax liability. The goal is no tax refund and no tax due, ideally. So based upon the completion of the employee's Form W-4, which is called the Employee's Withholding Allowance Certificate, which is easily found on the IRS website and must be provided to every employee to be filled out on hire. That's where we begin our calculations. So first, we're going to kind of look at the Form W-4 to begin with. Employees can only claim an allowance with one employer. So if they are employed at multiple jobs, they need to take care to not doubly claim an allowance. Now, the personal allowance, each person can claim an allowance for themselves as long as they're not being claimed on another person's tax return. They can also claim an allowance for a spouse that's not claimed on another person's tax return as well. Allowances for dependents falls in that you can claim an allowance for each dependent claimed on the tax return, depending on qualifications, and there are some requirements that are listed in the instructions of the W-4. The really nice thing about the W-4 is that it comes with a full list of instructions and a worksheet for the employee to use. The additional withholding allowances can only be claimed for withholding purposes, and only under certain conditions. If a single person with only one job, married person with only one job and a non-working spouse, or person's wages from second job or spouse's wages, or both, are equal to $1,500 or less. So this is really an unusual occurrence. Other withholding allowance refers to a determination based on the worksheet that's included with the instructions to the W-4 and are based on a variety of credits and itemized deductions from an individual's personal tax returns. From an employer's standpoint, you need to retain the W-4 as long as it's in effect and for 4 years thereafter under record retention requirements. While employers can help explain the instructions at a general level for the W-4, you should not ever tell the employees what to choose as far as allowances to claim. Here we have a representation of a W-4, just kind of as a general example here. And we'll talk about some things on the W-4, but this is just for your information only. The W-4 is used by the employer to determine the amount of income tax to withhold from the employee, and this form must be on file for all employees. Remember that there are instructions in a worksheet to help the employees in completing it, and never advise employees as to how many allowances to claim. But why would an employee choose the last option of married but withhold at a higher single rate rather than married? This situation may occur that couples with both spouses are employed, or a married employee with more than one employer may elect to have his or her federal income tax withholding computed at the single rate to increase the amount of income tax withheld. This goal is so that they don't have any tax due at the end of the year. Another area that you need to be aware of is the exempt status. So a person can claim this if the taxpayer has had no income tax liability last year and they're not expecting any this year. Exemption is only valid for 1 year. The employee will need to submit another W-4 for the next year indicating the appropriate allowances or exemption for that year. A person cannot claim exempt if they're dependent on someone else's tax return and income exceeds $1,050, including more than $350 of unearned income. Or if unearned income is less than $350, but total income is over $6,350. Now, there are some individuals that are automatically exempt, but again, you are not going to be advising any employees on how to fill out their W-4 or what allowances to claim. You are only going to ascertain that the W-4 is completely filled out and that it is signed and dated accordingly. So some basic W-4 information. Employees can change their W-4. When an employer receives an amended W-4, they have 30 days to change that in their payroll system. Employees, however, have to change their W-4 within 10 days for a decrease in the number of allowances. If there's an increase in the number of allowances, they can change it or leave in effect the old one. Employers must make it effective no later than the start of the first payroll period on or after the 30th day from the date the amended W-4 is received. Now, the employee may have some additional voluntary withholding agreements. This creates additional federal income tax withholding by either reducing the number of their allowances or requesting a specific additional amount to be withheld on line 6 of the W-4. Some of the things that employers can do. Employers can establish an electronic W-4 system, but they have to provide a paper option for employees that request it. Employers are not required to verify the authenticity of the information that's provided on the W-4. However, if the form itself is altered or the employee acknowledges to the employer that the information is false, the employer cannot accept the invalid W-4. Instead, the old one remains in effect, or if it's a new employee, you withhold it single and zero until they receive a new valid W-4. If for some reason an employee does not provide a W-4, then the employer needs to withhold at the single and zero allowances rate. Because the W-4 does have a Social Security number on it, employers can verify the Social Security on the W-4 by requesting to see and copy the Social Security card. A little bit more information on Form W-4. Now, this is unfortunately something that you're invariably probably going to have to deal with. Now, remember, you don't have to verify the authenticity of the information that's on the W-4. However, for an employee that feels the need to submit a W-4 that is not valid, has maybe way more allowances on it than it should, this would be willfully filing a false W-4. Employees who do so are, in addition to any other penalties, subject to fines up to $1,000 or imprisonment or both. Now, in most cases, people aren't going to have an extraordinarily high amount of allowances, and this would be a flag in theory if you had to verify the authenticity. However, that is not our job as employers. Resident aliens, these are people with green cards, are taxed similar to U.S. citizens, so there's no special procedures in place. However, non-resident aliens should follow this following process in order to not under-withhold. They should not claim exemption from income tax withholding. They should request withholding at single, regardless of what their marital status is. They should claim only one allowance. And they might add an extra amount to wages to determine withholding based on total amounts. They should also write non-resident alien on the dotted line on line 6. Now, sometimes it occurs that the IRS is going to reach out to you as an employer and ask for copies of W-4s. You only send copies of the Form W-4s after the IRS has requested them in writing. The IRS also has the ability to issue what are called lock-in letters to employers specifying the maximum number of withholding exemptions permitted for an employee without obtaining a copy of the employee's W-4. So what happens at this stage is that there's been something that has occurred with the employee's tax return for a number of years. They consistently owe and are having to make payment arrangements. So what the IRS then does is they send out a letter to the employer and says that this employee cannot be withheld at a higher amount of allowances than X. So you have to automatically adjust to that. The employee also receives a copy of that lock-in letter when it is sent to the employer. And then this notice must be given to the employee within 10 days of the receipt. If they're no longer employed, the employer has to notify the IRS in writing that they are not an employee or organization. You then withhold federal income tax based on the lock-in letter, starting with the first pay period 60 days after the date of the letter, unless contacted by the IRS. Any challenges to the lock-in letter must be sent in writing along with a new Form W-4 by the employee directly to the IRS. You are out of this once you give the employee notice of the lock-in letter. And then if the employee continues to give you new W-4s, you should disregard those unless they are claiming fewer exemptions than the IRS notice. So if the IRS caps or locks in allowances at 3, and they give you a new one saying 1, you can do 1 because that would hold higher amount of taxes. And you continue to ignore that until you are notified not to do so, until you're notified that it is no longer an issue by the IRS. Now, we just kind of talked a lot about the processes. The coverage, the taxability, all of this is very similar to your Social Security lesson. The difference now is that we're looking at just another tax. But there are some other types of pay that come into play. So pensions, this is where we have a defined benefit plan. Any pensions in excess of $20,640 per year. The rule of thumb is to withhold as if married with 3 allowances unless they complete a W-4P to change the amount of tax withholding. These amounts are treated as wages, and we calculate withholding accordingly. It is possible that the recipient can elect not to have taxes withheld. With a third-party payer of sick pay, in which there's the W-4S, this is only in play if it's coming from a supplemental insurance company. The recipient must file the W-4S with the payer in order to have federal income tax withheld. This is not when it is from somebody such as, it's not sick pay from your organization. You don't need a special W-4 for that reason. Now, coming into the next lecture is when we'll really start digging into calculating federal income tax, have a lot of different examples. So this next lecture will be cut into a couple to kind of give this to you in smaller pieces. While this class is, these lectures usually come out to be maybe an hour and a half. These are probably going to go longer because of all of the demonstrations that we'll have in them. So we will see you with the next lecture.